Okay, welcome to Monday, January 30th. Just a quick summary. In topic one in our accounting class, we looked at a general view of the field of accounting. In topic two, I gave you some exercises in using Excel. Uh, some of you may be very familiar with that, others are not. So that is important to review if you still are struggling a little bit with using Excel. Topic three, we start today. Topic three deals with financial statements, two primarily. As you know from topic one, accountants construct and use two main financial statements. There are a number of others, but we're going to concentrate on the balance sheet and the income statement. As you know already, the balance sheet will show what a business owns, the assets, what it owes, liabilities, and what the business is worth, the owner's equity, or sometimes called the net worth or capital, on a specific date, and that's important. Balance sheets deal with information only valid on a specific date. The income statement will show how much a business has earned, their net income, or how much it has lost, their net loss, over a period of time. This could be a month, it could be 3 months, it could be a year. Now, as you see on the screen, I've given you the balance sheet that you worked on last week. And we're going to do a little bit more with this. If you take a look at that balance sheet, assets, as you see, are on the left, and assets will always be on the left side of any balance sheet. Liabilities and owner's equity will always be shown on the right side of any balance sheet. Note that in the accounting world, and this is kind of important because we'll be talking about this a lot. In the accounting world, the left side of an account or the left side of a financial statement is always called the debit side. The right side is always called the credit side. Also be aware that the word debit, D-E-B-I-T, does not mean the same thing as the word debt, D-E-B-T. The word credit does not have the same meaning as, for example, credit cards. Just know that the word debit always means left, credit always means right. And we're going to be talking much more about those terms later. Okay, back to the balance sheet. The example from last week is very simple, showing some possible assets and liabilities. Now I want to introduce you to a couple other common assets and liabilities. If you look at the balance sheet on the next slide here, hang on just a second, you will see that in addition to the previous information, you now see another asset. You'll see right here accounts receivable on the asset side, valued at $8,000. Accounts receivable is a very common asset, showing an amount that customers owe to us. As you know, many businesses allow people to charge their purchases. The amount shown on the balance sheet for accounts receivable means that customers bought something but have not paid us yet. Since we do expect them to pay us sometime in the future, this account is an asset account. Later in the course, we'll talk about how businesses handle situations when the customer does not pay what he or she owes. Now look back at the balance sheet again and look at the effect of accounts receivable on the total of assets. You'll see that the total assets went up. Obviously, we've added another asset, so that makes sense. And more importantly, though, look at total of owner's equity. Even though we have not received the cash from those charged sales, we see that the value of the business has increased. Now, let's go back to the balance sheet, and we'll see that another new account will be added. This time there's a new account under the title Liabilities, and that new account is Accounts Payable. In this case, Accounts Payables is valued at $6,000. Accounts Payable is a liability showing an amount that we owe, the opposite of accounts receivable. Actually, the loans that you see on this balance sheet should also probably be considered accounts payable. They could be called loans payable, mortgage payable, or simply accounts payable. An amount shown on the balance sheet as an accounts payable means that we received something of value. We received an asset, but we've not paid for it yet. But it certainly is something that we owe, so it is considered a liability. Again, look at the balance sheet. You'll see the effect on the accounts payable, the effect that this accounts payable has on total liabilities. It's gone up from our original example. Obviously, we owe more. More importantly, though, the effect is also evident in the owner's equity. If you look at owner's equity, it's now gone down a little bit, in this case by $6,000. So just like any liability, it is in the end part of total liabilities, which is subtracted from total assets, which will give you the owner's equity. So the balance sheet that we constructed shows the worth of a business on a specific date, but it does not show how much the business has earned over a period of time. What about something called inventory? We don't see that on this particular balance sheet. But at some point, if this company is going to make money, they're going to have to sell something. Either they sell merchandise or they sell a service, but let's assume for a moment they sell merchandise. Merchandise would be called inventory. If you buy widgets, or if you buy food, or if you buy any kind of a product that you're going to sell, you buy it from the manufacturer, for example, or you buy food from the farmer, that would be your inventory. And you would pay for it either by cash or you would charge it. So if you would add inventory to the asset side and you pay cash for it, you simply would see that inventory is added, but cash would be reduced by that amount. If you would add inventory to the asset side, which would be the left side, and you charged it, you would have a corresponding accounts payable added to the liability side. So you have inventory, but you owe money for it. So again, we are starting with something to sell for our business, but the balance sheet doesn't show you how much we sold, how much we made, and that's where the income statement comes in. Also, the balance sheet shows that we have a building. That's an asset. But how much did it cost to provide heat and lights in the building so that our salespeople could sell the products? And we obviously had to pay those salespeople. Where do we see salaries? What about the taxes we had to pay in the past month or the past year to stay in business? All of these kind of questions are answered on the other financial statement that we will look at, the income statement. Together, those two financial statements give us a picture of the health of the business, both on a particular date and over time. The owners will use the information from those two statements as a basis for making decisions for their future of the business. They'll make decisions like, should we expand our business? Do we need to hire more employees? Can we give our employees increases in their salaries? Are some of the items selling well? Are some of the items selling not so well? The owners will depend on their accounting staff to give accurate information on which to base these and other important financial decisions. Okay, that's it for this lesson. Now go back to your course page.